Hi, I'm Ben. I'm from McGill's. Just before Christmas, we did a presentation on what Brexit might look like based on the scenarios that were going around the news and all the possible deals that might be in place. So now we actually have a deal in place. We're going to do sort of like an update webinar where we explain how import and exporting and VAT is going to work post Brexit. Now we know what the deal looks like. So if we get started, we can start to go through it. So the UK has entered a new era of relations. It's going to see changes to imports, exports, VAT. It'll affect travel, overseas work, and personal data rules as well, which we'll touch on at the end. But most of the presentation will focus on the stuff that affects businesses the most, which is imports, exports, and VAT. So if we get started. So the name of the model that we're going to be using for our import is what is called the core model. And it's being brought in three stages. So we have a stage one, which is coming in from the 1st of January, stage two from the 1st of April, and stage three from the 1st of July. And it's sort of like a stepped approach where we're gradually moving towards the way it's going to work. So stage three is going to stay forever. That will be the end of the deal with a sort of soft landing period of stage one and stage two. So in stage one, you require full customs declarations for controlled substances only, and these declarations can be delayed until after the 1st of July. So any controlled goods or you bring in from the 1st of January to the 30th of June, you will need to declare, but you don't actually have to do that until after the 1st of July. Also, although there are physical checks at the point of destination, so if you're importing goods, it'll be as they come into the UK. Most of these checks will take place as they come in, so you won't be, there won't be like border control posts checking many goods and services. From the 1st of April, you are required to give pre-notification of any health documentation for any goods you're bringing in that are of animal origin. So basically meat and food and that comes from animals. Physical checks will continue to be conducted in the same way. And from the 1st of July, we'll have full controls in place, which means the controls will start to apply to non-controlled goods as well. So anything that comes into the country will be subject to checks and border checks as they come in, and full customs declarations will need to be made on everything, and you'll need to go back and make declarations if you've imported any controlled goods in that time. If you go to HMRC, they have something called Appendix C in their core model, which lists all these controlled goods, but it's things that were controlled before, so like some electrical products and things that need to meet certain standards. Okay, so with the free trade agreement, there are several things that are going to change, forever. So whereas before we were saying there might be sort of mutual standards between the EU and the UK, this actually didn't happen. So the agreement doesn't mean the UK goods have to meet the same conformity assessments or safety standards as the EU. So as stuff goes in and out, you need to be aware that if you import goods from the EU, you need to make sure they adhere to UK standards. And if you export goods to the EU, you have to ensure that they adhere to EU standards. And those standards aren't necessarily the same. We also have quite a bit of red tape that's been brought in. And this is mainly related to the rules of origin, which we will touch on in a bit. And we will also go through the new VAT rules. But the main thing about the VAT rules is you may be required to be VAT registered in a number of countries, which is going to make things a bit more complicated. So there are steps you can take now. You probably should. We've been drilling you in to take these steps for a while now, but if you haven't, you definitely need to get an EORI number, which is if your business makes declarations or gets customs decisions in the EU, you need to have an EORI number in order to do this. And similarly, if you if you need to make customs declarations in an EU country, you need an EU EORI number to go along with your GB one if you import. You need to be prepared to pay or account for VAT on imported goods. So in the same way you used to pay import VAT on goods you import from non-EU countries, we're now going to be doing the same thing from EU countries. You need to consider the amount of time it's going to take to import these goods, because it's probably going to take longer than it did before. So you need to consider the implications this is going to have on how long it takes you to get your goods to your customers, and also the value of these goods, given that there's the additional red tape will probably lead to additional cost. You need to go through the rules of origin, which I said we're going to come on in a minute, and you need to make sure you know the origin of the goods you're importing or exporting, and you need to consider how declarations to HMR systems will be made, and whether you're going to use an intermediary, because there are specialist freight handlers and importers who will, in effect, do this for you, but they will obviously charge a fee. Certain industries, you'll also need to check if you require licenses for the goods, and to make sure they meet the new rules, mainly around the safety standards and things that we were talking about, because they are going to differ now between the UK and the EU. So the rules of origin, like I said, this is where there's lots of new red tape, and they've come up with a weird and wonderful way of determining these rules of origin, and it is important, because the rules of origin determine where a product is actually from. So whether it's EU, non-EU, or UK, and once we determine that, we determine the import and export rules around it. So the complexity comes where you have a supply chain. So if you have a good that's imported and it's in one state all the way through, so say mainly like food or raw materials, they tend not to change. So if you're importing wheat, it is wheat from the moment it's pulled out of the ground. The complexity comes with things like cars, where you have nuts and bolts that are turned into parts, which are turned into cars, and at each point, the state of the product is changing, and this affects whether the car originates, where the screws come from, where the parts come from, where the car comes from. So you need to know exactly in which country each stage of that process takes place. So for preferential origin, such as the UK EU, you need to have a substantial transformation through one of these following criteria. The first is a change of tariff classification. So the SIC codes, which we use in the EU, which we use in the UK, sorry, determine different classifications of goods. So, for example, the number for car parts is 8708, and the numbers for a finished car is 8703. So if a country assembles car parts into a finished car, they are changing the classification of those goods, of those car parts. So essentially, the country of origin becomes the country in which the transformation takes place. The second is if there's sufficient value add. So the original state must contribute a minimum percentage of the value of the product. So each component will add a certain amount of value, calculated as a percentage of the price of the final good. And to be a country of origin, the country must add a percentage of the value of the total product. So yeah, straightforward enough. And then the third part is finished products can qualify where specific working or processing activities are carried out. For example, a rule may require clothing products to be manufactured from yarn. So the precise rules are detailed and sort of change for each product. So we've done a brief overview, but there's actually detailed rules around every product. And these can all be found in this core model rules and the add-on criteria. But so if you're importing or exporting goods that have different stages of assembly, you will need to look at these rules for the items you're processing. So to comply with the rules of origin and gain the benefits of the preferential tariffs when importing from the EU, you must claim preference on the customs declaration and hold proof that the goods meet the rules of origin. This proof can take the form of a statement of origin, which is completed by the producer, so the person who is exporting it to the UK and who you are importing it from, or you need to hold sufficient knowledge of where the goods are originating. A 12-month grace period has been agreed, which means in 2021, you do not need the supplier's declarations, but you must still be confident that the goods meet the preferential rules of origin. So the UK has been reliant on the EU for all of its free trade agreements in the past. So all of our trade with America and Canada and places like that have always relied on the EU agreeing these rules with other countries. Now, after Brexit, the UK government is negotiating its own deals. So many of our existing trading partners, such as Canada, we are seeking to arrange new free trade agreements with other nations. So whereas before our free tariffs were only with the EU, the government is hoping to have similar sort of low tariff or no tariff agreements with other non-EU countries. But again, none of these have been decided yet, so we'll have to see how that progresses. Another big change with our dealings with the EU is around import VAT. So whereas before we had the reverse charge mechanism, so essentially whenever you imported or exported goods and services, the VAT was sort of dealt with at a government level, and you had to declare the imports and exports on your VAT return, but you never had to actually pay any VAT. Well, from the 1st of January, goods from the EU will be treated like non-EU imports because we're not in the EU anymore. So import VAT will be payable and customs declarations will need to be made around that VAT. You must account for VAT on all goods and services using something called a postponed accounting system. If you're doing a VAT return in some of the softwares now, you'll see that there's actually options to account for the VAT using, they now link to your HMRC, EORI accounts, and they can now import the postponed accounting VAT for your import VAT. What the postponed accounting system means is that import VAT on goods is accounted for and paid via the VAT return as usual, rather than paying it immediately at the point of entry. So if you were to import something from a non-EU country, so say like India, you would actually have to pay VAT as the goods enter the country. Whereas under the new EU UK rules, you can just account for that VAT on your VAT return and pay for it as normal. I've covered that one. So a business must include its EORI number on its customs declaration and its VAT registration number if you're VAT registered when you're importing goods. You can then account for the import VAT on your VAT return when it submits a declaration that releases the goods into free circulation. So you're not allowed to reclaim the VAT as input VAT until the goods are actually released in the UK. So even if you've imported them and if you're holding them in for import and they actually haven't been released into the market yet, you're not allowed to account for the input VAT until that's all been declared. So if they're being held in places like customs warehousing, inward processing, temporary admission, you're not allowed to account for the input VAT yet. So this is mainly for the bigger importers, but everyone can use it. But if you import goods regularly, you can set up something called a duty deferment account that allows you to delay customs charges, including import VAT. So through this account, you pay the duties and import VAT monthly, normally on the 15th of the next month, rather than paying for it as and when you import stuff. So this means on average, you defer duties for about 30 days, it's anywhere between 2 and 6 weeks, and you settle payments in a single go rather than having to pay for each consignment as it enters the country. A further complication with VAT is around the whether you need to VAT register in all the different countries of the EU. So in order to determine this, you must determine where a supply takes place for VAT purposes, so that you know whether VAT due is payable and if and where you have to register for VAT. Similarly, if an EU business is selling to British customers, they will probably need to register for UK VAT from the 1st of January. To remain VAT compliant in EU member states, it might be a good idea to appoint something called a fiscal representative. So they're a VAT agent for foreign businesses, and they will deal with the VAT registration in another country. Because obviously, if you're going to VAT register in France, one of the biggest issues is that we don't speak French. So understanding all the rules can be difficult. The fiscal representative is then responsible for the calculation and reporting of VAT to their client. So, and they are the first point of call for the local tax office in case of questions or audit. So again, we go back to France. So if you have a fiscal representative in France, they understand the rules. They are also responsible for the accurate reporting of that VAT. So you're almost, if it's wrong, it's on them rather than on you, as long as you pay the VAT that they tell you to. There are special rules for consignments below 150 euros, which is about £135. Imported goods below this value, excluding specific excise goods and gifts, will not be subject to import VAT and will be subject to sales VAT instead. This means that the person doing the exporting will have to account for the VAT rather than the importer. The low value consignment relief no longer applies, and VAT will now be charged in goods as if they were supplied in the UK and accounted for by HM Revenue and Customs on a UK VAT return. Reclaiming VAT in the EU. So if you incurred VAT in the EU before the 31st of December, HMRC has set up a special refund portal that's open until the end of March, and you can reclaim the VAT using HMRC's portal. Any VAT incurred in the EU after the 31st of December, you'll have to reclaim manually from the tax authority of the country where you incurred that VAT. The supply of services. So following this agreement, the way we actually account for VAT on services has changed very little. So business-to-business services are treated as though they're supplied where the customer belongs, which has always been the case. So the only difference is that the amount of VAT we pay and reclaim and declare is going to be the same. The only difference is that before we reported it as reverse charge, and now we'll report it as an export. It's only sort of like a classification change in our VAT return. The actual process will be exactly the same. When we're receiving services, you may still have to apply a reverse charge to the receipt of services from non-UK suppliers. This is where the reverse charge mechanism may still come into play. Sales of digital services. So if you supply digital services of more than £8,818 to the EU, you actually have to account for VAT at the VAT rate of each individual state where you supply that VAT. So you would apply the French VAT rate to sales in France and the German VAT rate to sales in Germany. Helpfully, there is a system called MOS, which enables you to file one VAT return that essentially accounts for the VAT on all these sales at all the different rates. If you are currently using the UK VAT MOS scheme, then nothing will change and you can carry on using the scheme as it does at the moment. If you don't use the MOS scheme and you have to register and you start having to account for VAT in these member states, you can still use MOS, but you'll have to register in an EU country rather than in the UK. So rather than using the UK MOS scheme, you'll have to use the EU MOS scheme, which it basically enables you to file one, rather than having to do the sales and input of each country on each individual return. It's a big return that lets you put each country's sales, each country's supplies, and have a VAT amount due for each country. Saves lots of time. So I said we'd touch on personal data. So the EU has agreed a period of 4 months, extendable by a further 2 months, in which data can be exchanged in the same way as it is now, as long as the UK doesn't change any of the data protection rules. After this period ends, the data rules are likely to remain relatively unchanged because UK businesses will still need to comply with UK data protection law, which is unlikely to vary that much from EU data protection law. We will need to comply with any changes to EU GDPR if you offer goods or services to goods or services to monitor behaviour of individuals in the EU. So if you hold data for EU citizens, you will need to comply with EU data laws. A review of the data you hold or your data transfer protection procedures are recommended if you do hold data for EU people. Retaining and recruiting talent. So for existing EU workers, employers should check whether you need to apply to the settlement scheme. A person is eligible to be settled if they started living in the UK by the 31st of December 2020 and have lived in the UK for a continuous 5-year period. 5 years continuous residence means that for 5 years in a row they've been in the UK, the Channel Islands or the Isle of Man for at least 6 months in any 12-month period. So basically for the last 5 years, they have to have spent half their time here each year. The deadline for applying for settled status is the 30th of June. For any new non-UK workers, after the transition period, you can still recruit EU citizens, but you'll need to apply for permission and obtain the necessary visas. To recruit workers from outside the UK, in the skilled worker category in future, you need to demonstrate that they speak English to the required level, have a job offer from a Home Office licensed sponsor, which an employer would need to apply to become a sponsor before they employ the non-EU people. The job offer is at a required skill level of RQF3 or above, which is basically an A level, and they'll be paid at least 25,600 or the going rate for the job offer, whichever is higher. If the job pays less than 25,600, but no less than 20,480, you may still be able to apply for permission by trading points on specific characteristics against their salary. So that would be things like whether the UK is short of people in that job or it's deemed a worthwhile job. A business must also apply for to be a visa sponsor if they intend to recruit from overseas. The impact on travel. So from the 1st of January, there are new rules for travel to the EU, Switzerland, Norway, Iceland, and Liechtenstein. Under these requirements, UK nationals, you'll need a visa if you want to stay in the EU for more than 90 days in a 180-day period. Should you or any representative of your business need to travel in the EU in the future, you'll need to consider the following. So you need to check your passport. You'll need to get travel insurance that covers your healthcare, because previously we were automatically covered in the EU and we no longer are. You'll need to check that you have the right driving documents, because this may change in the future. You need to tell HMRC you'll be working in the EU. You need to check whether you need to pay social security contributions, so what we would call PAYE, in the country you're working in. You need to check whether, if you're an employer, you need to check whether you need different insurance for your employees if they're working abroad, and you need to check if you need to take goods to the EU that you have the right documentation to do so. If you're working in the EU, UK professional qualifications won't be recognised automatically, which will make it more difficult to get work in the EU, especially if you're in the service sector. If you're looking to work for longer periods, you may need to acquire authorization via a work permit for most EU countries. In most cases, you'll need a job offer from the country where you want to go to work before you go there, and you'll need to get a visa to move there. You should check with the UK-based embassy of the country you want to work to see what you need to do, because the rules may differ slightly in each country. So we've run through quite a lot of stuff in quite a short amount of time. Obviously, the slides will be on our website if you want to have a look at them. But if you want to speak to any of us, there's our 2 numbers for the Cirencester and Malmesbury office. Feel free to give us a ring. I don't want everyone ringing me. Any other team can help. But if you need any help, do give us a ring and let us know. I hope you have a good day.